2026, which sectors would you classify in favored and which one would be in unfavored?
Indigenization of defense is one theme which is strongly played out over the last 3 years or 5 years. As a country, we do need it. But from an equity return perspective, I don't think that one can make too much return going ahead because it has been a favored sector. Unfavored, I would say, is that companies which are...
So I was reading there are 3 key filters which you apply. Can you explain to a young investor what are these 3 filters and how do you apply them while picking stocks?
To a great extent is overlooked is the supply side, because supply side ultimately decides how the return ratios for the industry is going to pan out. If supply side is disciplined, you make phenomenal returns, irrespective of how demand side.
How to identify good quality investments?
Like if ROEs is 18, companies growing at 15, even if you're getting at between that 18 to 20 P, right, you should just slap on it. If you get an opportunity, one should look at them aggressively.
In 2026, which of these 4 asset classes you are bullish on? Hi everyone, welcome to ICICI Prudential AMC's Fund Manager series, where we interview the fund managers and get deep dive into what they are thinking about the markets. Today we have with us Mr. Ihab Dalwai, who is going to help us understand what is going to happen with the markets and going to help us understand about mutual fund investing as well. Thank you so much, Ihab, for doing this. How are you doing?
Yeah, good. Thank you for having me.
Thank you so much. So for people who wouldn't know about you, how would you like to introduce yourself and how has your overall journey been like?
So basically, like, I've been associated with ICICI Prudential for last 15 years now. This is my first organization where I've started working after I passed out from my CA. And I've gradually moved up the responsibility curve. I started as an analyst for almost 5 years and then moved up in a role of a joint fund manager. Have been working closely with the CIO in a couple of mandates during the joint fund manager journey, and now I've taken independent charge for a couple of strategies and being associated with one of a large strategy as well on the equity side, which is the multi-asset strategy as well.
So let me ask you a tricky question here. Tell me something which is not there in your resume. This was something which is all there in your resume. Tell me something which is out of your resume as well.
People who've been associated with markets, I think they invest a lot of their personal time also being associated with markets. So I think we don't have too much of personal life or too much of things outside markets to discuss. But apart from that, personally, like whenever I get time, I like to just spend that time with my family, my 2 daughters who are there now. And any time after that, I watch a bit of sports. So that's how I try to spend the free time. But I think it's difficult if you are associated with markets. It's just not a 9:15 to 3:30 job. You need to read a lot. You need to understand a lot of companies. You need to understand global macro and a lot of other stuff as well. Because in this age of technology, you have so much information. How do you process that information and then convert into decisions? I think that's a very complex process. So that takes a lot of time. And so that's it. Yeah.
So you said you're a chartered accountant and I also come from the same CA fraternity. I know how difficult it is to clear these exams. Tell me the most interesting anecdote from your entire CA journey and why was that very memorable or something that was very challenging and you learned that from your CA journey?
I think what CA journey teaches most of us is grit, determination, because it's a 0-1 game. Because if you pass, then you are through. But if you don't, that effort doesn't count much, because that's the main degree which you're working towards in your entire career. So I think planning, hard work, determination, and I think most employers also, I think, end up hiring us CAs is because we've gone through this process. It's not because of what we've learned. I think what the program builds out of a person in terms of character, and that's what employers appreciate more than what, obviously the learning part is there. It builds us in different fields within the finance and accounting aspect. But I think how it prepares an individual, I think that is also appreciated by an employer.
So if there is any CA student who wants to clear their CA exams, what are some 2 or 3 advice you have for that person to clear the CA exams?
It is similar to any competitive exam, right? Like you need to plan well, you need to get the best of like coaching if required, and you need to execute, I think, whatever the plan is. And you need to be very organized. You have to have a timetable, a schedule. You need to cut down on any extracurricular activities you may be engaging in during that period of your preparation for the exams, because this is a very important aspect or turning point in your career or your life. So you need to give full determination and focus to that exam. Once you're past that exam, you can get involved in a lot of other activities, and people say that you can enjoy your life in a lot of other aspects, but I think you need to have 100% focus and determination while preparing for the exam.
I remember my CA days as well, and I used to study for 12 hours a day for 5 months with my mobile phone switched off. And that entire journey or lifespan taught me about patience, and secondly, taught me how to maintain equilibrium between your personal life and professional life from a very young age, because we are exposed to articleship right from 17 or 18 years of age.
Correct.
And then you have to work for 10, 12 hours, manage your academics, go to the classes, and then study for 12 hours a day for 4, 5 months. That was something which was insane, and that really helped me to stay disciplined in my
Correct. No,
journey as well.
yes, yeah.
So you said you manage multi-asset fund here. For a 13 or a 14-year-old who doesn't understand about mutual fund investing, how would you explain what exactly is a multi-asset fund for a new person who wants to understand about it?
Yes. So, from a categorization perspective, so SEBI has categorized funds into different buckets or baskets. So, the multi-asset category within the offerings is a scheme which can invest in multiple asset classes. So, by asset classes, equity is one asset class, debt is another asset class, and the third asset class is commodities. So generally you have certain hybrid strategies. Hybrid means you have blend of two or more asset classes. So you have a plain vanilla hybrid where there's equity and debt. Uh, Multi-asset adds one more asset class to it, which is commodities. So you'll have predominantly three large asset classes where one can invest in, which is equities, debt, and commodities. Obviously, you can do some other smaller asset classes as well, REITs, which is, I would say, a blend of equity and debt as well, but that is a very small portion. But these are three large asset classes you can invest in a multi-asset fund.
So who exactly is this fund for? And if there's a young retail investor who wants to start investing, do you think that it is good to start off with this kind of an exposure at a very early age?
I would think so, because see, I strongly believe, and my firm also strongly believes in an asset allocation strategy, because being overly dependent on a single asset class, uh, I think the journey of the returns is also would be volatile, and there can be phases of that particular asset class which it can go through a lull. So to avoid that experience, it is important that one has an asset allocation approach to investing. By that, I mean that you have some allocation to each of the asset classes. But I also strongly believe in a dynamic way of managing money. By that, what I mean is that one should not have a static allocation to each asset class. Like it should not be I would say, 50 or a 50-40-10 allocation, which is static throughout the entire journey of the investing period. It has to be dynamic, because each of the asset goes through its own cycles. So if one outsource the decision of the asset allocation to us in a mutual fund setup, we end up determining the cycle, where are we in the cycle for each of these asset classes, take an informed decision of how much to allocate to each asset class. And then the outcome is that once one does this approach of investing, asset allocation investing, your return journey is also healthy. But the biggest advantage of investing in an asset allocation approach is that your risk profile dramatically reduces. So classically, textbooks teaches us risk in various definitions. So one is your volatility of return can also be defined as risk. Few of them define downside, like if stocks or if a portfolio corrects, that is also a risk. So there are different definitions of risk. What this strategy does, to a great extent, reduces risk on both levels, volatility and to some extent the downside as well. So on a risk adjusted basis. So because as an investor, I think it's always important to assess a product on a risk adjusted basis, because return is a function of how much risk you take. So if someone is taking excessive risk to generate the return, it may not be a great journey, because it will go through a very volatile journey, and you may not be entering that product at the right time, right? So if you enter and there's a big drawdown in the product, your journey may not be that great as an investor. So if a product is able to generate superior risk adjusted return, which we feel that this asset allocation strategy does, and there is data for that as well. The lot of risk adjusted ratios which are there to assess a product show that the hybrid category has superior risk adjusted ratios. I think the investor journey is phenomenal. And then he did not worry about timing the market. I think that worry which most of the investors have, like, should I enter this asset class? Should I enter the market now? Where should I enter the market? I think that decision making is relegated or I would say delegated to the professional, the mutual fund manager. So I think the worry should not be there for the investor. You should just do a lump sum investment in these strategies, and then uh, withdraw from these strategies as per their financial planning. Like if they have some goal metrics which they have, a house buying or a big expenditure, and then they want to withdraw money, they can do it from the strategy, but they don't need to time an entry and exit from this strategy, is what I would say.
So you said you invest in multiple assets. So equity is one, debt is one, commodities is one. You also mentioned real estate investment trust, REITs is another.
Yeah.
So how do you decide how much percentage of money will go into which asset class? And in 2026, which of these four asset classes you are bullish on?
Yeah. So people can have different approaches of doing asset allocation. The way we've adopted is that we have a combination of we have various models which we've built internally for different products, and we use it for this products as well. So we have a valuation based model to assess where are we in the valuation cycle for equity. Uh, and and as a house, and I personally, I think we strongly believe in cycles. So all asset classes have to go. Generally, if you look at history, long history of different asset classes, they go through a cycle. Nothing is structural. Like nothing is going to go one way up. It will have to go through a cycle, is what we strongly believe in. And if you have that belief, I think using models with a lot of back tested data, which you can use to forecast as well. So we use a lot of valuation models to determine where are we in the equity cycle. We tend to adopt earnings cycle as well, like where are we in the earnings cycle. So like post COVID, earnings were depressed. So you were in an early stage of earning cycle or a business cycle or an economic cycle. You can put it in either of the way. So you were in a increasing earnings growth market. Like earnings growth was very strong, accelerating.
When you say earnings growth, it's the profitability growth
Of companies. Yeah, profit growth of companies, that was very strong because the starting point was very suppressed post COVID. But after that, you would have reached an up stage of a earning cycle. So from there on, earnings growth would be at an index level, may not be as strong as what we've seen in history. Then you need to do more bottom up stock picking to identify stocks which will grow faster. So there is a valuation cycle, there's an earnings cycle. Apart from a model, I mean, valuation model and an earnings model. And then obviously you take into consideration sentiments also. So if there's a lot of investor money chasing a particular asset class, I think to make prospective return going ahead, if too much money is chasing an asset class, is difficult because generally what we have seen, a lot of money chasing an asset class, and then post that 2-3 years down the line, that asset class doesn't do that great. So I think inherently what we believe in terms of managing money is you should have to some extent, a counter-cyclical approach of investing, which is trying to identify asset classes or segments of market which are currently not doing that great, where there is not too much investor interest. And based on our research, we feel that the asset class is a good asset class to invest in. Maybe in equities, like we expect earnings growth to recover through consolidation of the industry, so on and so forth. Can be multiple reasons. In commodities, we feel that supply side, there is a deficit. So the medium to long term outlook is good, but in the near term, there's not too many investor interest in that commodity. I think those are the times when one needs to actively look to invest in that asset class. But so having a counter cyclical approach, using models to determine how the asset allocation has to do. But we do it intuitively as well. It's not like we are completely dependent on models. We use the assistance of models, but the ultimate decision is, like, there are multiple fund managers in our strategy. So we have both the CIOs, like I mentioned, I'm involved, and few other of my colleagues are also involved. So we jointly, to a great extent, take a decision.
You also track another ratio which I was reading in one of your articles in Money Control, which is called as corporate profit to GDP
Yeah,
ratio.
correct.
And basis that you decide how the earning cycle is going to look
Correct.
like. So if I can ask you in 2026, what is that ratio? How do you interpret that? And how do you come up with a conclusion that what will the earning cycle look like?
So if you plot that ratio on a very long term, like a very like 20-year chart, right, or a table, you'll see that the ratio has somewhere been has bottomed at 2% to gone to 5-6% on the higher side. During, like I mentioned, during COVID, it had gone to 2%. So there, I think COVID was a beautiful time because you had valuations suppressed, you had corporate profits being suppressed. So you had this acceleration of earnings from this 2% to going to 5.5%. I think that's where we are currently. Uh, and you had multiples also going up. And this is, see, it's important to understand when the ratio increases, right? That means your corporate profits are growing faster than nominal GDP. So if nominal GDP is at 10-12%, which is currently, and if the ratio is accelerating, that means your corporate profits are going at high teens. So now I feel we are in the upper end of the ratio because corporate profitability is phenomenal, I would say. Most of the companies are earning very good ROEs, return ratios. That's one other way of looking how corporate profits are. I think we had the banking sector where pre-COVID there was a bit of earnings suppression because of certain asset quality issues. But I think to a great extent those have normalized. Banking profit is also phenomenal. Lot of margin expansion we've seen in corporate India. So I feel that the ratio is at a higher end today. So going ahead at an index level, earnings growth should be in sync or slightly better than what the nominal GDP is. So that would be at index level. But obviously, as active fund managers, our job is to find stocks which can grow faster than the index. So that's what we end up doing. But at an index level, that's how I feel. We are at the upper end, and that's how I don't see that ratio coming off because I feel corporate balance sheets are in the best of the shape because leverage is low, banking system is doing very well, and so they can invest to grow these corporates. But looking at the margin profile across sectors, I don't think that there is scope for further margin expansion across most of these sectors. So it would be may grow slightly higher than nominal GDP corporate profits, but the ratio would be at 5 to 6%. And generally, we've seen a long-term average; it's there in that range, 2 to 6. In case we see a big, I would say, technology shift or something of that sort, or a lot of innovation-driven earnings growth, because that corporate profit to GDP in US is quite high as a ratio, and I think it's higher than 10% or even higher. Uh,
Despite the GDP being so high over
yeah,
you.
so I think in India, I think we are in this range until unless we see a breakthrough in tech and a lot of corporates become global corporates and start earning on a global landscape. I think it would be in this range, is what I feel.
So just to simplify it for our audience, you're saying that when the corporate profit to GDP ratio is let's say 2%, which was in COVID,
Correct.
that was a good time to enter in the markets because the profitability growth was lower than the GDP growth. It was like little undervalued. And once it is at 6.5%,
Yeah.
that is slightly on the higher side. So you would not be comfortable going into equities hardcore. Is that correct?
At 2%, that means, yes, it means that it can grow at nominal GDP, but I think corporate India as an entire pack is under earning today. Because historically they have earned 5-6% of GDP, but today if they're earning 2%, that means they're under earning. So potential for them to earn higher going ahead is higher.
Yeah.
It may take time. It can be a 2-3 for a period of time, but I think one should look positively at that asset class when an asset class is under earning. You had undervaluation and under earning. That would be a phenomenal time to invest in a asset class.
And this same number for US, you're saying 10%. So is like, for example, if the current number is 5.5%, if we compare it with US, it looks under penetrated. So can we have this interpretation also that this might also go from 5.5 to 8.5, 9 in the near future?
Like, I've not done a deep study in these ratios across geographies, but I feel it's very difficult for a country to break the range in which they have historically traded. I think US, because of, I still feel the tech-driven or the big four or big seven companies which are there in US, which are a phenomenal earning generating powerhouse. I would say I think it's predominantly because of them. If it was only dependent
Right.
on US economy related stocks, right, I don't think they would have gone this high as a ratio.
Right. So you also divide markets into two parts. One is favored sectors, one is unfavored
Yeah.
sectors. If I ask you in 2026, which sectors would you classify in favored and which one would be in unfavored?
So generally, sectors which have done very well, I would say, would be classified as favored sectors, and sectors which have not done well. So unfavored, I would say, is that this is something which I have believed in even last year, and I think as a house we had launched one new scheme as well, which is the quality fund which we had launched. I still feel companies which are high ROE businesses, like high return generating businesses, have underperformed the broader market over the last 3 years, 5 years. So there are certain high quality stocks where the stock price is same for last 5 years. I feel, and obviously the earnings has grown. It's not like the earnings had not grown. That means they have derated. The starting point valuation last 5 years ago may have been wrong. But what I feel is that to look at quality as a segment today, I think that's a good segment to look at, and it can be across sectors. You can, and but predominantly you get them in a consumer facing businesses. I would say predominantly, like maybe in discretionary, consumer discretionary part. Within that, retailing is one segment. Autos has also been one segment, but autos has done well. So I wouldn't say it's an out of favor sector, but it fits into the broader quality segment, which I like. Within mid and small cap space as well, there are across, like within the manufacturing space, within the consumer oriented space, there are decent ROE businesses which have underperformed for last 3 to 5 years, which look attractive today, I would say. And in case of favored sectors, I would say basically any theme which I think has done very well is something I may not look to participate. Though I'm not doubting that theme is a wrong theme to bet on, but from an equity investment perspective, I feel I may not end up making returns. So I think I feel indigenization of defense is one theme which is strongly played out over the last 3 years or 5 years, and I feel that theme it's a good theme. As a country, we do need it. We need to invest and we need to localize our defense equipment purchases and so on and so forth. But from an equity return perspective, I don't think that one can make too much return going ahead because it has been a favored sector. Similarly, I feel certain power equipment, capital good names have done very well. I'm saying that theme is not wrong because there is power shortage. AI led data center demand would lead to more power demand globally or in India, and there is equipment shortage as well globally. But I don't think this shortage to be a chronic shortage. It can be a year or two. Obviously, supply will catch up to the high demand which is there. May take time, but where the valuations are today, to make returns in equity on a 2 to 3 year basis looks difficult in that segment. So there are pockets of favored pockets, I would say, which have done very well. And the themes are also not wrong, I'm saying. But from equity investment perspective, I think it is
So you mentioned the word
relatively
quality
good.
and you focus more on quality. And in fact, as a fund house at ICICI, you said that you also launched a quality fund. When you say quality, what do you exactly mean by that? And there's a framework that you use in your stock picking selection, which is QARP framework, quality at reasonable price. There's one more
Correct.
framework, which is GARP, which is growth at reasonable
Reasonable
price,
price,
etc.
yeah.
So what exactly is quality at reasonable price? And if with examples, if you can explain to our audience how to identify good quality investments.
Correct, correct. So I think ultimate the test or the litmus test of quality is return on equity. Because if you're able to if you're able to generate high returns on the equity which you've deployed, that means your business is superior. It is high quality. Second, the consistency of ROE, if you can generate, like that also shows that you don't have a cyclical business. Your business has pricing power. and you have a strong, I would say, moat. I think Warren Buffett uses the word moat, right? That means you have developed or built something which is difficult for competition to entrench into, and at least in the near to medium term, and that I think ultimately gets reflected in the ROE. So if you do business, if you have moat in your business, the ultimate outcome should be you should generate decent ROE. So any company which generates high ROE consistently over a period of time, I think those are very high quality businesses. Obviously, it attracts competition because competition would also want to earn that ROE. So it's how do you defend the moat is also very important from a company perspective. So for us, it's important to know that how the company innovates as well, because something which has done well, obviously competition would try to replicate that and may make your strong moat slightly a weaker moat. So how do you innovate and continue to maintain that dominance? I think that is important to assess. For that, I think management quality is important. What is the management doing? How is it strategizing? Understanding that aspect is important. One other outcome of management decision making is capital allocation. What are they doing with the excess earnings which they're doing? Because generally, if you have a strong business, you will generate cash flows. So if you don't do anything with that cash flow, your reported ROEs will come down because cash doesn't generate as much return as your business is generating the high ROEs. So you need to do something with the cash. If you're able to, a company which is generating high ROEs is able to reinvest that cash flow in that ROE, I think that's a phenomenal business. That means the company is saying, I have a visibility of growth as well. That's why I can reinvest this cash flow and continue to generate that ROE. In case a company doesn't have that visibility of growth but has a moat in that business, it has to pay out to the shareholders. That's how it can just pay out the cash which is generated to shareholders and maintain the high ROE at a business level. So, to your question, I think uh, generally investing styles are bucketed into quality or growth or value. How I look at it is that what is the first filter the investor is putting. So if the first filter for investing is high ROE businesses, that means I'm tilting towards quality style of investing. That doesn't mean that growth and valuation is important for me. It is, but my first filter is ROE. So if I have a low ROE businesses, I don't want to invest in them in that particular strategy. Similarly, for a growth investor, his first filter will be growth. So is the business growing or no? So if the business is growing, even if the ROE today is low, he may take a view saying that eventually when scale comes, ROEs will improve. So that for him, the first filter is growth. And for a value investor, the first filter is the stock cheap or no. ROEs and growth may be a secondary issue. Like ROEs can come, growth can eventually come. It's going through a cyclical downturn. So I think the first filter which the investor applies defines what the style of investing is. So, but having said that, like I mentioned, ultimately to have a successful investment outcome, I think you need a combination of all three, which is very difficult in the market to get. Like it's very difficult to get a high ROE business which is growing, which is cheap. So I think because it will be like an undiscovered stock, no one wants to invest, but is on an operating parameter generating both high ROE and growth. So I think you need to balance out on the three. Obviously, fund manager styles tends to tilt towards one of them. But if you are able to get, I would say, a high ROE business which is growing cheap, right? You should just slap on it. So one metric I see is like if a company is generating in high teens to 20% ROE, is growing at around 15%. If you end up getting at around 20 P, right? Like if if the P is lower than the two of them, just buy it. But it has to be higher than cost of equity. Like I'm just saying, like if ROE is 18, company is growing at 15, even if you're getting at between that 18 to 20 P, right? You should just it's a very attractive investment to look at. So I think very difficult to get in this market environment today, but you should keep searching for such companies and if you get an opportunity, one should look at them aggressively, I would think.
So let's talk about the filters for stock selection in your multi-asset fund. So I was reading there are three key filters which you apply. One is under earnings, one is industry structure, and the third one is ownership patterns.
Correct.
I think we've spoken a bit on under earnings, but can you explain again to a young investor what are these three filters and how do you apply them while picking stocks?
One other interesting aspect of investing, obviously, under earnings is there. Like, so for to just to complete on the under earnings part, is like there are at times business can go through its own cycles where commodity pressure is resulting in margin suppression, or few other challenges is resulting in margin compression. Uh, Overall environment for that particular segment is weak, so that's why volume growth is low, or maybe heightened competitive intensity is resulting in lower volumes today. So one has to take a call of that the company's under earning today is than its normalized earning. So one can take a call that earnings will normalize, and in that normalization of earnings journey, it's possible to make returns. Second, I think it's very important to understand industry structure as well. And for that, I think I'd read somewhere that most of like from an analyst fraternity or community perspective, you all keep trying to forecast demand. Like, how is demand going to shape up? I think what to a great extent is overlooked is the supply side, because I think supply side ultimately decides how the return ratios for the industry is going to pan out. If supply side is I would say disciplined or well balanced, and or competitive intensity is coming off, I think you make phenomenal returns, irrespective of how demand side, like demand is accelerating, decelerating, it doesn't matter. If supply side is consolidating, you make phenomenal returns in that particular sector. I think one classic case which people do talk about is the telecom space, right? Like 10 years ago or slightly longer, you would have multiple players, which is a highly fragmented market. But then when the supply side got consolidated to almost three players or slightly higher, but the returns of that sector phenomenally improved because earnings also improved. Similarly, if you look at, I would say, airline industry today, uh, it's not about the market structure in India. Obviously, there is one player who is a dominant player, but you have to look from the supply of aeroplane perspective. The backlog is so huge in terms of Airbus supply or Boeing supply. Supply side is constrained. So now, irrespective of how airline demand goes up or down, uh, you supply side is predictable. You know that for the next 5 years or 10 years, the planes are already booked, and which are the players who want to get it. There can't be a new player entering into the market because there's no planes available in the market. So supply side is very, I would say, disciplined, uh, to a great extent consolidated. No new player can enter in the market. So supply side looks good in the aeroplane or the airline industry, I would say. But generally, people say airline is a gruesome industry. You don't make too much ROEs, so on and so forth. But today, the environment is such that supply side gives us comfort that it is an okay industry to be invested in. So similarly, I think that is important. That's what I mean by industry structure. Focus on supply side. Similarly, like if you see too many players doing capex in a particular sector, like I would say chemicals as a space, right? COVID or post-COVID, there was a phenomenal earnings upcycle which we saw in chemical space. And then what most of the companies did was that they reinvested that earnings. So a lot of capex happened. That was also okay from an India perspective. But when you look at China's chemical exports, they are so oversupplied on the chemical side in China that irrespective of wherever the prices are falling, China keeps exporting chemicals on the global landscape. So supply is not, I would say, favorable. Obviously, if China starts to curtail capacity on the chemical side, I think that can be a turning point in the chemical space. But that's a difficult call to take. It's a policy decision based in China. So monitoring or understanding supply side is very important from an industry structure perspective. And last part which you said is right is ownership. So generally, a counter-cyclical approach generally doesn't like to be uh, investing in a crowded space, like where there are too many people chasing the same theme or same stock. So ownership matters because I strongly believe if a stock or a segment is under-owned, right? Even if there is bad news which comes into that sector or stock, it doesn't correct because there aren't too many sellers in the market left to sell that stock. But if you have a view on that particular stock and that view plays out, the potential for returns is quite high because that then attracts a new set of investors into that particular asset class. So generally, see, ownership can't be a criteria of decision making, but it's always a good hygiene check in terms of seeing what is the ownership in that particular asset class or particular sector or stock where you're looking to invest.
And when you say ownership, like this is basically ownership by what kind of people, or are you meaning liquidity here?
So, ownership generally means flows in that particular category or a stock over a period of time. So, like in equities, also, right? Like if you see a stock which is either promoter held and you see a couple of institutions in it, I would say it's still under owned.
Okay, got it.
But if you see like a stock which has obviously the promoter held, then you have like 10 large institutions already invested in it. Then you have large FIs already invested in it from an ownership perspective. I would say it's well owned.
Hmm.
So your research has to be quite strong in that stock because it has to meet the earnings which one is forecasting. And not only that, I think it has to beat the earnings. I think stocks which are well owned, right, they'll do well only on earnings revision upwards. So if the earnings growth was expected at 15%, if the company grows at 20%, that's when the stock will do well. But if it ends up delivering 15%, which in itself is a good growth, but if it's meeting earnings estimates, right, a well owned stock may not end up delivering great returns. So I think earnings revision also plays a factor, but that's when the stock is well owned. It does well in a positive earnings revision, like beating the earnings estimates. That's when it does well.
So let's say if a stock has very few FIIs or like very few selected outside investors, that is under-owned. If a stock has like 10, 15 or maybe large list of institutional investors and even the promoter holding is there, that is well owned. So in
Yeah.
a case where earnings growth is higher, the second kind of company will do well as compared to the first one.
No, I'm saying that in case earnings growth comes,
Yeah.
the first one, which is under owned,
Yeah.
will do well irrespective of
Okay.
what is the earning
Got
market's expectation out of that stock.
Okay.
Because there's not too much expectation because it's not owned also. I think not many people will be tracking it also because it's not owned to a great extent. But a company which is well owned, even if it meets the expectation, like if because in the market there are a lot of broking houses which forecast how the earnings will grow on a lot of these stocks. So even if it meets that earnings growth, like if 15% was the growth expected, it delivers a 15% growth. A well owned stock may not react that positively versus an
Got it.
under owned stock at 15%.
Right.
A well owned stock will have to beat the earnings growth expectation. It has to do at 20% growth
Right.
for it to do well. Whereas an under owned stock, I think even at 13% also, if it ends up delivering lower than what the market was
Yeah.
expecting, it can do well, an under owned
Mm.
stock. So it need not beat the market expectation also.
Fair. So, from what I understand, we cannot look at under-owned and well-owned in isolation. We have
Correct.
to look with the earnings growth that
Correct.
is happening.
Correct.
And if we have both these in sync, then the earnings growth, if it is higher, under-owned stock is something which will
Do very well.
do very well as compared to the well-owned stock
Well owned
because
stock.
it is already meeting expectations and it
Correct.
should go beyond expectations in order to give better returns.
Exactly. Exactly.
Got it.
Yes.
Perfect. Very, very simple to understand. Thank you so much for this. In early 2025, I was reading an article where you said that market volatility is here to stay. What is your answer for this in 2026?
One of the reasons why I would have said it because of global uncertainty, especially because of tariffs which had been imposed by the U.S. administration. I think that was one of the reasons, and because that was a change from how the global order or global setup was. And there was a bit of, I would say, de-dollarization or dollar depreciation as a thought process, which was picking up because of certain issues in or issues, I would say, or the way things were shaping up in US. So I think I think the reasons were more global. I wouldn't say volatility is the cause of volatility is domestic, because our macroeconomic indicators are phenomenal today. Uh, Even in the current budget, we saw, right, fiscal discipline or consolidation was the key theme of this year's budget. So government has delivered on what it has promised in terms of fiscal. A current account is quite stable, is quite low. Inflation is at it's one of its lowest. Like 10 years earlier, who would have thought like inflation in India would be lower than that in developed world? So that is the case today. So I don't think volatility is the cause of volatility is domestic. It is more global. And if you look at a particular asset class also, I think equity, the volatility will be slightly higher because, like I mentioned, valuation is not very cheap. Like it is, as an asset class, it is well owned. It's not an under owned asset class, to put it in that context. And So, generally, in a well owned asset class, volatility would be there, especially when, like I mentioned, you've reached a level of earnings. So, a lot of earnings surprises or disappointments will result in volatility because it being a well owned asset class and earnings are also slightly elevated. So, yeah.
And in 2026, so would you think that there might be, let's say, a stock market crash in the short term and then it might correct? What's your view?
So, see, broadly, if you look at Indian stock market corrections, also, right, they have come up predominantly either because of a global crisis, be it a financial crisis or a banking crisis or liquidity crisis, so on and so forth. But or when our Indian macroeconomic environment is slightly weak, so very high current account deficit, which results in slightly rupee being very volatile, higher inflation. So, like I mentioned, domestic macroeconomic indicators being very good. I don't think there would be a large correction in the Indian equity market because we have a stable macro. We from an ownership perspective, though I said it is well owned, but from a domestic perspective, but foreign investors have not been active participants in the Indian equity market for at least, I would say, last 1 to 2 years. They've not been a large buyers in the market, so that potential is there. So I think from that perspective, I still feel that there may not be a large correction. But having said that, the return expectation I feel should be moderate because, like I mentioned, we are not in that early stage which was in COVID, right? Of low earnings and low valuation. We are at an evaluation basis, we are at an average or slightly above average. On an earnings basis, we are slightly higher than what the valuation is. So I feel that the return would be moderate, and it is an environment of active fund management where you need to do bottom up stock picking, get your research calls right. I think that is what will drive delivery of performance.
So you also mentioned the term de-dollarization, and if I can just simplify it for our audience. So de-dollarization, and you can correct me if I'm wrong, it's basically where people don't, like, banks don't want to rely completely on dollar, and central banks are now selling their dollar US treasuries, dollar reserves, and then they are buying gold because of the entire US Russia sanctions thing happening. So the trend here is now that everyone in the world would want to not rely completely on dollar, and that's why the term de-dollarization has happened, which is why gold prices also, when central banks started buying gold, it also like rallied significantly. So as a fund house, what's your entire view on the gold and silver rally that happened in the last 2 to 3 months, and where do you see this going forward?
Yeah. So I think we've been, if you look back at least 2 years ago or 3 years ago, we had been quite positive on commodities as a space, be it gold or silver. And there, I think our rationale was that real rates in US are very high, and then when real rates come down in US, the commodities do very well. And that was a very long-term history, like I would say 20 to 30 years history, which shows that real rates and commodities doing well. Uh, but ironically, this time around, the commodities rally happened without real rates in US coming down, which was so it's broken the very long-term correlation which it had with real rates. So that again gets us to the point that there is something beyond what the conventional correlation was, which results into what you stated, that central banks want to diversify their asset side, want to some extent move away from dollar, get back into hard assets like gold. But having said that, going by the very basic conventional thought process which I said, right? Is it a crowded space today? I feel it is to some extent, commodities. And I think one classic example is if you look at the ETF flows which came into gold in January, which the data is out, I think around 25,000 crores of money came into gold as an asset class in ETFs alone in January. And I think that to some extent had some impact on the import bill also. I'm not pretty sure if that is it's a correct correlation, but our import bill in the trade balance has slightly gone up. Gold imports have gone up. Can be because of the very high ETF flows which you've seen in gold.
So it's because we are investing in ETFs and these companies will have to buy
Yeah,
physical
all
gold.
ETFs has to be
Uh-huh.
backed by your physical gold.
So that's why they will import more of
More
physical gold, and
correct.
that's why import bills have increased.
That's what I think. I
Okay.
think because I don't think jewelry demand has
Yeah.
shot up a lot because gold prices have gone up. So it is basically the investment demand which is driving the gold surge which we are seeing. So I feel it is to some extent a bit crowded space today. And the preference from a multi-asset perspective, from an on an asset allocation side, I would prefer equities today after it has to some extent underperformed over the last 1.5 years versus commodities as a space. But having said that, I'm not saying that uh, it has to be a zero allocation to commodities. So that's not how we've positioned our strategy. One will have to find relative picks within commodities. So that's what I think one has to do when asset classes are expensive. Like commodities expensive today, equity is also not cheap. Debt is also done decent, I would say. So how do you position a portfolio, right? You have to have a relative preference thought process. So within this constraint which I have of deploying money in equity, what is the best outcome which I can do on a relative basis? So I think within commodities also, if one adopts a relative thought process, because commodities is not only restricted to either gold or silver, right? You can have a basket of commodities as well. Copper, zinc, crude, or so and so forth. So I think having a relative thought process can help investing within the commodity space.
So just if I can summarize, so you're saying that equities is something that you will prefer as compared to commodities, but having said that, there should be certain allocation on commodities as well.
Commodities, but on a relative pick, you should find commodities which can do well, which fits into the thought process of under owned and can there's not too much investor interest today. So that thought process, yeah.
So are you trying to say that gold and silver specifically, if I talk about these two commodities, in 2026 they've already rallied a lot and you don't expect a higher rally from this now and it'll be stable?
I think yeah, I would still say gold is okay because gold to some extent has genuine demand, right? Like you said, central bankers are large buyers. There's a genuine jewelry demand as well for gold. Silver, I feel it's more, I would say, investment-led demand, which is there. The depth of the silver market is also not that great, unlike gold. So I think if there's a surge in investment demand, right, it leads to a very sharp movement in silver, like what we've seen over the last 6 months. I think we would prefer gold versus silver because of the demand supply dynamics of gold versus silver, which is the depth is low and it has been purely driven by uh, investment demand, and that too not long-term investment. It's not like no central bank buys
Yeah.
silver in their on their asset side. So
Right.
if a central bank buys, it's like a long-term buy and hold investor which has come into that market. It is more, I would say, people who want to make quick returns who've got into the commodity. Yeah.
Fair, but what about silver demand? Now, if you see, like silver, 65% of the silver demand is also used in industrials. Gold, if you see, like gold is not used in industrial, it's only used
Correct.
in jewelry. But silver is used in electric vehicles, it's used in like a lot of industrial
Solar
use, solar
mod.
panels,
Yeah.
etc. So that is not an investment demand, in my opinion, right? So,
Correct. That's true. That's true. It has
so that
a
is also
genuine
increasing.
industrial use
Yeah,
demand. But the current surge in prices, I think we've seen is because not of the surge in the investment demand, but because of the surge in the investment, not of the surge because of the industrial demand,
right, fair.
but because of the surge in the investment
Investment demand.
demand.
Got it.
See, the topics of it being used in solar, EVs, those were true almost a year back as well.
Yeah.
So I think it is not, and what we've observed also in few articles which we read is that because of the surge in silver prices, right, few solar module manufacturers in China have tried to reduce the use of silver in the manufacturing and trying to substitute with some other commodity. So I think that can
Hmm.
also pick up in
Because
terms
the
of
raw material cost will go higher
go
for them.
very high for
That's why.
them. So
Okay.
they would look for substitution, yeah,
Hmm.
as well.
Got it. Very interesting. So just a last couple of questions before we end this. So if there's a young investor who's watching this, let's assume there's a 21-year-old who's watching this, doing a job, making 6 lakhs per annum, which is 50,000 per month, wants to invest 20% of this in mutual funds, which is 10,000 per month. What is an ideal mutual fund allocation for this young investor, which will make him at least like financially stable in terms of categories if he has to invest 10,000?
Correct. See, when I look at people who started their jobs
Yeah.
recently or early in their career path, right? Obviously, expenses are there, but I would urge, I urge the newer generation or the early career people that you have to save higher, you have to invest aggressively in terms of allocation. I'm not talking about the product being aggressive, but in terms of your allocation needs to be higher because if you don't invest early in your career path, right, you will not get the benefit of compounding. So if you start late, then the advantage of compounding to a great extent reduces. So I would I would urge them that obviously you meet your basic requirement of expenditure because obviously your starting salary also may not be that high. But as your salary curve goes higher, you can then venture into a lot of discretionary spending which you want to do. So I would urge them not to buy houses early because that locks in a lot of your capital for a long period of time, uh, keeps you away from the investing journey. Not do large ticket other expenditures as well. Not buy it depends, but not do avoid the discretionary spend as much as possible. Be a bit frugal in your early stage of career and allocate as much as you can to investing.
Not buy iPhones on EMI.
Oh yeah, exactly. Or not do foreign travel on EMIs and
Yeah.
so on and so forth. Uh, I think that is important because if you start early, like I mentioned, your compounding
Yeah.
journey is very good. And obviously, once your salary curve goes up, and when you are in your mid career or like you've done 5 years or 7 years of a job in a particular setup, I think then it's when you can slightly venture into things. But yeah, focus more on investing early. That's important. Yeah.
Like you'll be surprised to know this, but I was reading an article where Gen Zs are taking loans to go for a concert and attend a concert as well
Yeah.
because they want to show it on their Instagram stories that, okay, they have attended a Coldplay concert or any other concert. And this is also a trend right now where they are taking like phones on EMIs, laptops on EMIs, that foreign travels on EMIs, just so that they can have Instagrammable
Yeah,
content.
to maintain the
Yeah.
social status, but I still feel I think it drives you away from the investing journey, and
Yeah.
I strongly believe if you start early, it is quite a liberating feeling once you are through like 10 years or 20 years into investing. I started like obviously college time investing is not investing. It's just experimenting in the market. But actual investing, I think I would have started in 2012 or 13, 12, I would say. So it's been 13, 14 years. I think obviously Indian markets have done very well over the last 10 years. So anyone who had invested would have done decent. So I think once you are 10 to 15 years into your investment journey, I think you would see how your portfolio grows, and then I think to venture into certain stuff is possible. You can then buy a house, you can then venture into stuff. But yeah,
What percentage of salary do you think should go into investing?
I would say as much as possible. Like I think basic needs like your rent or logistics, and obviously I'm not saying obviously you should have a budget for entertainment, so on and so forth, but be as frugal as possible is what I would recommend.
So maybe
And whatever
30%.
surplus remains, just invest is what I would say.
So is like 30% or 40% a fair number to
See,
assume?
it's I would say like it would be a challenge because initially salary levels generally starting salaries in Indian corporates is not that great because supply is quite tremendous. But once you do well in an organization, you progress well. So initially it may be difficult, but because you need to meet your basic requirements as well. But I would still ask for a higher share for investment if possible, like 40-50% if you can do.
Okay.
I think nothing like it uh, because the compounding journey will be phenomenal. Yeah.
Right.
But it's a difficult task. I know when the starting salary is slightly low, but yeah.
Yeah. And asset allocation, if we talk about that, so what's an ideal asset allocation for a young 21-year-old who's starting investing in terms of percentage in equity, debt, commodities, and any other asset class, if any?
So if a person is doing asset allocation at his own at an individual level, I would still feel if you're young, you can be aggressive. You can have higher allocation to equities because you may not need the fund immediately, right? Because I would assume that you passed your education phase, and there may not be large ticket expenses which can occur to you. Obviously, marriage can be one, but apart from that, I still feel that uh, equities should be a large portion of that individual. Obviously, it will go through its own volatility, but you don't need the money immediately. Obviously, I feel that if you can hold it for 10, 15, 20 years, because if you're early, like you may not need them until you're 40, 45. I think equities should be a large chunk of your allocation, but I would still recommend the individual to do it through fund houses, the asset allocation, because it is more cost efficient. If one tries to do it at an individual level, the cost incidences are higher. But if it tries to do it through a mutual fund setup, it is smoother, quicker, doesn't have to worry about, it doesn't have to assess where is he in that cycle of each asset class.
Right.
So I think that is
So even if they do it through mutual fund vehicle, what proportion or what percentage do you think would be ideal for a young investor? When you say high on equities, what would that be? 60, 70% is a fair number to assume?
yeah, I think that's okay.
How much
Yes.
should be in debt, commodities?
See, debt, I would say commodities also can be at that lower end of around 10% or
Okay.
slightly lower, also 5% is also okay, I would say. But I think debt is also like a safety net, right? Like it's more of a safety net because uh, some expenses can come as an emergency also. So I think debt investing should be always seen as a safety net uh, rather than a source of compounding. Because yeah, so just to meet your any emergency expenditure which can
Yeah.
come. So for that, and if that is met, I think you can invest in aggressively in equity. But I would still suggest if a person who is professional and is working in even in finance industry or is working in a non-finance industry, I would still urge them to do it through a fund route, the aggressive investing which they're doing. Because when I say aggressive investing, that doesn't mean that they have to go down the capitalization curve and buy the high risky stock in terms of a micro cap or a small cap. I mean aggressive in terms of allocation, how much you are putting into equities
Right.
as a proportion.
So debt should be around 5 to 10% again, is what I assume.
Yeah, slightly higher also because
Okay.
if you have like early stage, it may not the savings may not be large, but
Right.
yeah.
So, and no real estate, as you said.
Early, I would urge not to. because I still feel rental yields in India are quite low, right?
Right.
Like 2-3%. And maybe 10-15 years into your career, you
Yeah.
can look at a real estate, because by that time you may have a family, and then I think it's better to have a static or a stable house rather than moving around
Right.
here and there. So I think, yeah.
So the perfect ideal asset allocation for a young 21-year-old investor would be 10% commodities, 10% debt, and around 75-80%
80%
equities.
equities.
That is
But
a
there
very
again,
good
I'm
approach.
saying equities, but I would urge them to do it through
Mutual fund.
mutual fund setup, because direct stock investing is risky.
Yeah.
You need to deploy a lot of your time to it. You need to monitor it.
Yeah.
So I think that is
Yeah, I agree with you. You know, I used to do stock investing earlier, and then I've stopped that, and I'm only doing mutual fund investing. I have my own SIP, which is going on in 7-8 different funds, and I've just started doing that, and it's so easy, so peaceful. I don't have to track what is happening with the
Correct.
companies. So it becomes
Correct.
much easier. Thank you so much for doing this. Last question that I ask all the guests. It's going to be a tricky one. If you were in the shoes of Kushal Lodha, and if you were interviewing Mr. Ihab Dalwai, what is one question you would like to ask him towards the end?
One thing is that the survival rate in the fund management industry is not that great, I feel. So it's a very tricky industry. I think a lot of individuals, young aspirants in the finance world or investment world aspire to be fund managers. Rightly so, because it's an exciting job. You get to meet so many people, so many industry leaders, company owners. You get to learn a lot from them. It's a decision-making job, because generally I feel decision-making jobs are good jobs, because they are like at the forefront of an organization. But if you look at the history of Indian fund managers, very few have survived a long tenure in a single place, like in a static organization. So I think the survival rate is low globally as well. Like there have been very famous fund managers who have done well in a 10-15 years, but then they try to do something else, and then they do something, but this is what I tell, but it's like, you in fund management I've seen is that you succeed till you fail type thing, because the end is what I've seen for most of them is that they've not succeeded that well. There are few who have done phenomenally well, and I always say that my boss Naren, he's one of the person who's survived for a very long period of time, almost I would say 25 years or so his career would be. But it's a very challenging profile, though it looks good from outside. But because to keep doing well on a continuous basis is a challenge, because there can be a phase of time where you may not do that great, like 3 years you may underperform, because, and I think there's this uh, other person who I like to read about. So what she says is that like in studies, right, when you do your exam.
Sorry, who's the person?
This is Rupal Bansali. Like she's written a book called Non-Consensus Investing, and what I've seen in her interviews, what she says is that in any competitive exams, right, you have a set of questions, you answer them correctly, you do well. Like both of us can answer them correctly, and both will do well. But in investing, and especially in institutional style investing, which is for a mutual fund, it's either both of us have to get it right, and I have to, like, for me to succeed versus you, I would say I have to get it right and try to ensure that you don't get it right. So only then I would succeed, because market is a zero sum thing, right? And most of the investors are very smart investors who invest into the market. So you have the brightest of the mind, and you have to outshine them. So you have to, what she says is that you have to get it right and try to be slightly non-consensus. Only then you succeed, because you have to beat the market. So beating the market is a challenge, because it's a combination of great minds, and you have to do better than them. So that is a challenge, and to do it on a continuous basis again is a challenge. You can do it like a short period of time, 5 years, 10 years, but to do it on a 20-year basis consistently is I think if someone can achieve it, I think it's a phenomenal outcome. But very few end up doing it, is what I feel. So I think that's the question is that I think can I do it? That's what I keep wondering.
Yeah.
I think I'm at least I feel I'm in the early stage of my fund management career. Like it would be around 7-8 years, which have been actively like a sole responsibility of fund management I've got. I have a long way to go, but that this fear is there in my mind. Can I do it on a continuous basis for a long period of time? That is a challenge, I feel.
What's the most memorable interaction with Mr. S. Naren, or what have you learned from him?
No, I think I've learned phenomenal. I think the learning journey has been phenomenal, and he believes in the concept of what do you say? Take chances and give chances also. Like obviously take chances in the terms of in markets, like you take risk, you take active bets, and give chances. I mean opportunities to all of us in the organization. I think uh, he's a very rare individual in terms of the industry who has done phenomenally well on the investing side as well and on the business side as well, where you rarely get an individual who does both. Uh, so there are few people who do excellent on the investing side who would beat benchmark very well. But when it comes to scaling up the investing offering which you have, I think on that aspect also he's done a phenomenal job. So he's a superior investor and a superior business leader as well. So I think both, obviously investing is one learning which we've all tried to get as much as we can from him. But on the business side also he's done a phenomenal job. So I think like I said, he's a rare outcome. I think one should not expect that all of us would have a similar journey to what he's had, but for him to be around, and I think the other great part about him is that he always likes to give feedback. And for us, and investing is as an industry, it's something which one does a bit on its own. Like there's not much like obviously there's discussion, debate, but ultimate decision is an individual decision to a great extent. So if you have someone who is so well experienced, who is giving us feedback on a continuous basis, it is important. It's good for us because we can improve our own processes, and I think that is a great outcome for us as well. So for him to be around while we are going through our fund management journey, I think it's a great outcome.
Yeah, I remember when I was shooting a podcast with him, like extremely humble, and the way like just treating me also like he doesn't know me. And I shot a podcast last year, welcoming and then dropping off till the lift, etc. I think commendable gestures, very kind. Thank you so much for doing this. I really had an amazing time. I'm sure everyone who's watching this, they've learned a lot from you, and you've explained everything in a very simple manner. Thank you so much once again for doing this, and wish you all the best for your future endeavors.
Thank you so much for having me. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.